Assalamualaikum and hello everyone. Today I will be discussing about MFRS 101. This standard focuses on the presentation of financial statements. Our goal here is to understand the framework MFRS 101 sets for financial statements, ensuring they are transparent, consistent, and comparable. MFRS 101 provides a structured framework for presenting financial information in a clear way. It is designed to help companies report information in a way that stakeholders can easily understand. This standard aligns closely with IAS 1 under IFRS, but it is tailored specifically for Malaysian reporting requirements. So next, the objective of MFRS 101 is straightforward. It aims to ensure that financial statements are very clear, consistent, and also comparable across different reporting periods. This clarity allows users to make better economic decisions based on the reliable information. And next, we move to the core components that MFRS 101 requires in every complete set of financial statements. There are 5 main elements in the financial statements, and first of all is statement of financial position, which is commonly known as the balance sheet. This provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. Next, we have statement of profit or loss and other comprehensive income, which shows the company's performance over the period. And the third one, we have the statement of changes in equity, illustrating any changes in shareholders' equity. And the fourth, we have statement of cash flows, detailing the cash movements, inflows and outflows of the company. And lastly, we have notes to the financial statements, which include the summaries of significant accounting policies, and also it is non-financial reporting. MFRS 101 also introduced some key principles. Firstly, consistency. This principle ensures that financial statements are presented similarly across the past reporting periods, making it easier for users to compare the information. And next, materiality and aggregation. Only material items need to be disclosed or presented separately. This means immaterial items or not significant can be aggregated, ensuring that the financial statements are easy to follow and also not messed up. Additionally, MFRS 101 requires statements to be prepared on a going concern basis, which means the company expects to continue operations 1 or more years in the future. Disclosures are also need to take into account. Companies are required to disclose significant accounting policies to provide users with insight into the accounting principles applied. The standard also requires disclosure of key judgment and estimates that could significantly affect the financial statements. This is very important because it allows users to understand assumptions made in the preparation of financial statements. Finally, any errors or misstatement must be disclosed, especially if this will affect the comparability of the statements over time.
Hello everyone, so I'll be continue our discussion regarding the key parties involved in the development of Malaysian Financial Reporting Standard 101, also known as MFRS 101, presentation of the financial statement. So the main organization in this collaborative effort are the Malaysian Accounting Standard Board or MASB, the International Accounting Standard Board IASB, and also the IFRS Foundation itself. Okay, first let us talk about MASB. MASB is responsible for adopting and also adapting international accounting standard for Malaysia. They issue MFRS 101 in 2011, aligning with global practices to be effective from January 1, 2012. This adoption is part of Malaysia policy to converge with international financial reporting standard, or what we call IFRS, in order to enhance their transparency, comparability, and consistency in their financial reporting, both with Malaysia and also internationally. Next is ISB. So, in the global standard stated that first issued IAS 1 in 1997. Since then, IAS 1 has been revised several times, most notably in 23, 27 and also 2011. This revision focused on making financial statement presentation clearer and also more user-friendly. The IASB mission of creating high-quality standard laid the foundation for MASB adoption for Malaysia. Lastly, we have IFRS Foundation. The foundation holds the copyright for IFRS standards and provides essential resource for their development. Collaborating with the IASB, the foundation ensure that standard like IAS 1 stay relevant as the financial landscape change. Their support allows standard like MFRS 101 meets both global consistency and also the local needs. Okay, so what we can summarize from these three parties is the collaborative work between MASB, ISB and also the IFRS Foundation in developing MFRS 101 underscore the importance of international cooperation. This partnership ensures that Malaysia financial reporting not only aligns with global standard but also maintain relevance to local market. Such effort result in financial statements that are reliable, comparable, and also meaningful to stakeholders worldwide.
Assalamualaikum and hi, my name is Tarif Zizat Answarini and my metric number is 29120. Moving on to the theory development of MFRS 101. The first one is normative theory, describe ideal accounting practices based on what should be rather than merely observing what is. It is concerned with setting a framework of principles and standards that define the most appropriate accounting methods to achieve desired outcomes. In the context of MFRS 101, normative theory plays a significant role in shaping the presentation standards for financial statements. It emphasizes key principles such as transparency, consistency, and comparability, which are critical to ensuring that financial reports meet the informational needs of various stakeholders, particularly investors, creditors, and regulators. Normative theory has helped create a structured, standardized approach to financial reporting. This ensures that the information presented is not useful for stakeholders, but also reflects an ethical commitment to fair and accurate representation of the company's financial health. Okay, moving on to the next one, which is positive theory, focuses on explaining and predicting the actual behavior of accountants and managers when they select certain accounting policies and practices. Unlike normative theory, which prescribe what accounting practices should be, positive theory seeks to understand the why behind real-world accounting choices. This theory is based on the idea that individuals act in their own self-interest, which often influences the accounting methods they choose, whether for managing earnings, reducing tax liabilities, or meeting contractual obligations. The positive theory has played a significant role in shaping MFRS 101 by ensuring that it reflects the realities of corporate financial reporting. By analyzing real-world accounting practices and the motivation behind them, the theory has encouraged the inclusion of elements in MFRS 101 that align with how businesses operate. Okay, the last One is regulatory approach, emphasizes the critical role of regulatory bodies in setting and enforcing accounting standards to safeguard the public interest and promote economic stability. This theory is grounded in the belief that the actions of businesses and accountants should not solely serve their own interests, but should also align with the broader needs of society. By establishing standardized rules and frameworks, regulatory bodies aim to ensure that financial reporting is fair, transparent, and reliable, thus fostering trust and confidence in financial system. Regulatory approach supports the objective of MFRS 101 by emphasizing the need to maintain public trust and confidence in financial reporting. By mandating standards that minimize inconsistencies and guard against misleading or inaccurate financial information, regulatory bodies help prevent financial misstatement and corporate scandals that could undermine market stability.
Next, I will discuss on the nature of MFRS 101. MFRS 101 is considered a principle-based accounting standard, unlike rule-based standards, which provide specific rigid guidelines. MFRS 101 offers broad principles that give businesses the flexibility to make decisions based on their specific circumstances. This approach encourages professional judgment and aims to present a true and fair view of financial statements. First point is flexibility in financial reporting. MFRS 101 allows companies to present financial statement in ways that best represent their true financial position. It doesn't require rigid formats, which lets companies adapt their report to their specific business needs. Second, encouragement of professional judgment. MFRS 101 encourages companies to use their judgment, especially with unique or complex transactions. This approach contrasts with a rule-based system, which prescribe specific rules for every scenario. By allowing judgment, MFRS 101 helps companies capture the economic reality of their transaction. Third, focus on reporting objective. The standard prioritizes useful information for decision making without detailing every procedure. This means that companies have flexibility in deciding what's essential to disclose, making the information more relevant to users. Next, comparability and accountability. MFRS 101 requires key principles to ensure comparability across periods and entities, but allows variation in how information is presented. This adaptability is valuable for companies facing different regulatory or business requirements. Lastly, adaptation to changing business environments. MFRS 101's principle-based nature allows companies to apply broad guidelines to new types of transaction or financial tools without waiting for updates. In fast-evolving industries, this flexibility is essential. To conclude, MFRS 101's principle-based approach provides broad guidelines and encourages judgment, offering flexibility that is essential for today's diverse and fast-paced business environment. This adaptability ensures that financial statements reflect the economic realities of businesses, making MFRS 101 suitable for various industries and evolving financial situations.
Hello, my name is Afiq Asfar bin Kamaruddin, matrix number 291255, and I will be presenting about the limitations and also the solutions to our chosen standard. So we have come up with two limitations, and the first one is about complexity. MFRS 101 outlines detailed requirements for financial reporting, such as how to classify income, expenses, and assets, and the full disclosures that must be made. While this ensures the accuracy and comparability, it makes the standard difficult for SMEs to follow, especially those with limited resources. Unlike large businesses with dedicated finance departments, many SMEs rely on a small team or a single person to manage their financial reporting. For example, a small manufacturing business may struggle with the complicated process of calculating and reporting machinery depreciation without a deep understanding of the standard. Moreover, MFRS 101 requires businesses to make challenging decisions such as defining materiality, making financial forecasts. These decisions demand a strong grasp of both accounting principles and business knowledge. The interrelationship between MFRS 101 and other standards adds another layer of complexity, making compliance even more difficult for SMEs without specialized accounting teams. As a result, many SMEs must hire external accountants for consultants that increase their operational costs. This complexity also affects stakeholders and investors who may find it difficult to understand the data. Moving on to the next limitation is it only focuses on only historical financial performance. One key limitation of MFRS 101 it is focused on historical financial performance only, which may not fully meet the needs of stakeholders that are interested in a company's future. MFRS 101 mainly presents the retrospective data, and that is the past income, expenses and assets, which is valuable for understanding past performance. However, it offers limited insight into a company's future goals, challenges or opportunities in rapidly changing industries such as technology or renewable energy. Past performances may not accurately predict future success. For example, a tech company with strong financial history might face risks from a competitor's new technology which historical data wouldn't show. In times of economic instability or industry shifts, relying on historical data can become irrelevant, making it difficult for investors or creditors to assess a company's ability to navigate future challenges to make better decisions. Stakeholders need a broader perspective beyond just only rely on past performance. So by looking at those two limitations, we have come up for a few solutions, and the first is technological and automation. Automation helps streamline the reporting process by automatically collecting and organizing data, saving time and reducing the risk of errors. This allows finance teams to focus on analyzing the data and providing strategic insights instead of spending hours on manual tasks. It also enhances the accuracy, performing real-time compliance checks with FRS 101 to ensure reports meet regulatory standards, minimizing costly errors and non-compliance issues. Technology makes financial data more accessible using visual tools like dashboards and graphs to present complex information in a way that easy for people to understand. As business grows, automation is scalable. Systems can handle more data without increasing complexity, making the reporting more adaptable to business needs. Moving on to the next solution is by including proactive data in the financial statement. MFRS 101 focuses mainly on historical data, but adding forward-looking information can provide a clearer picture of a company's future. Management's forecasts and financial projections such as projected sales or earnings from new products or market expansion help show growth potential. Companies can also share budgeting and business plans to outline their strategies for achieving their financial goals, along with risk and opportunity and analyses that highlight potential challenges such as market instability and opportunities like new customer segments or technological advancements. By combining forward-looking data with past performance, businesses give stakeholders a fuller understanding on both current results and future potential, enabling a better decision-making.